The $5 drop that rewrote the rules. The morning started like any other. Coffee cups were being filled across trading floors in New York, London, and Shanghai. Screens glowed green. Silver was holding steady, quietly confident near its daily high. Traders were calm. Investors were comfortable. And then everything changed. At precisely the moment that one government report hit the wire, the silver market did not just dip, it did not correct. It did not pause. It collapsed. Within minutes, the charts that were glowing green turned violent red. The selling was not scattered, it was not panic-driven, and it was certainly not random. It was clean. It was calculated. It was deliberate. And by the time most retail investors even looked up from their morning routines, $5 had already been stripped from silver's price. Billions gone. Not slowly, not gradually, but in one swift, surgical, and devastating move. Now, here is what the headlines told you. They said it was Iran. They said it was the ceasefire collapsing. They pointed to the oil spike above $91 a barrel and called it a day. And millions of investors nodded, accepted the explanation, closed their laptops, and moved on. But serious analysts, the ones who watch not just the price, but the architecture behind the price, they saw something entirely different. Because here's the truth that no financial headline will ever print in bold letters. Markets do not move on news. Markets move on data. And today, one specific piece of data, released quietly, without ceremony, without press conferences, without a single mainstream anchor mentioning its name, that data point pulled the trigger. To understand what really happened today in the silver market, one must first understand what silver actually represents in the global financial system. Most people look at silver and see a metal, a commodity, something that sits in a vault or gets used in electronics and solar panels. But experienced market strategists look at silver and see something far more important. They see a mirror. Silver reflects the world's collective anxiety about inflation, about interest rates, about the future purchasing power of money itself. When investors believe that inflation is rising and the Federal Reserve will be forced to keep rates elevated, silver suffers. When investors believe that the economy is weakening and rate cuts are coming, silver thrives. This is not theory. This is the pattern that has repeated itself across every major market cycle for the past 4 decades. And today that mirror cracked. Here is what actually unfolded this morning step by step. At 8:30 a.m. Eastern Time, the United States government released a data report. Not with fanfare. Not with breaking news alerts. Quietly, the way governments always release the numbers they know will cause disruption. Inside that report was a single metric. One number that told the Federal Reserve and every institutional trader watching that the inflation fight is not over, that rate cuts, which markets had been quietly pricing in for the second half of this year, are now off the table. Not delayed. Off the table. And the moment that reality landed on trading desks across the world, silver did not wait. Silver never waits. The institutional sell orders that had been pre-positioned, already loaded, already aimed, were released. What followed was not a market correction. What followed was a controlled demolition. Price fell to 75.29 by midday. Billions in precious metals positions were wiped clean. And across every major financial hub on the planet, the smart money was already moving, repositioning, preparing for a timeline that now stretches deep into 2027. The retail investor, the one who trusted the headlines, the one who believed it was Iran or oil or geopolitics, that investor is still holding positions built on the wrong story. And that is precisely where the danger lives. Because what happened today in the silver market was not the end of the story. It was only the beginning. The real trigger, the buried number, the institutional blueprint that made this collapse not just possible but inevitable, that story starts in part 2. The number buried inside the report. The number buried inside the report. Every market collapse has a birth certificate, a precise moment, a specific cause, a single origin point where the damage was decided long before the public ever saw it coming. Today's silver collapse was no different. And to find that birth certificate, one must travel back exactly 6 hours before the chaos erupted on trading floors across 3 continents. Because the real story did not begin when silver started falling. It began when a quiet government document landed in the hands of people who actually move markets. At 8:30 in the morning, the United States Bureau of Labor Statistics released its latest inflation data. No dramatic announcement, no breaking news alerts, no primetime anchor interrupting scheduled programming. Just a PDF, a table of numbers, a government report that most investors scrolled past without a second glance. But buried inside that document was a figure that did not just surprise markets, it dismantled them. Core inflation, the measurement that strips away food and energy prices to reveal the deep structural inflation running through the bones of an economy, came in significantly higher than every major Wall Street forecast had predicted. Not a minor miss, not a rounding error. A significant, unmistakable deviation from what markets had spent months positioning themselves to expect. And in the world of institutional finance, a miss of that magnitude does not just move prices. It forces an entire recalculation of the future. For the better part of 6 months, global financial markets had been operating on one central belief. Inflation was cooling, the Federal Reserve was winning, rate cuts were coming before the year ended, and the era of expensive, restrictive monetary policy was finally drawing to a close. This was not just casual optimism shared among retail investors. This belief was structurally embedded into the price of almost every major asset on the planet. Stocks were priced for rate cuts. Bonds were priced for rate cuts. Real estate was priced for rate cuts. And silver, sitting near its yearly highs with confidence, was priced for a world where the Federal Reserve would soon loosen its grip and allow capital to flow freely again into hard assets and inflation hedges. That entire pricing structure collapsed at 8:31 in the morning. Because what the inflation report revealed was not a cooling economy moving obediently toward the Federal Reserve's targets. It revealed an economy where inflation had quietly reaccelerated beneath the surface, invisible to casual observers, but brutally clear to anyone who understood what they were looking at. The institutional response was not panic. Panic is for those who did not prepare. What followed the data release was something far more calculated, far more surgical, and far more devastating to the ordinary investor who was still reading headlines about Iran and oil prices, trying to make sense of a collapse that had nothing to do with either. The sell orders that hit silver within the first 2 minutes of the report were not decisions made in the moment. They were preloaded, pre-positioned days in advance by trading desks that had studied the inflation forecast distributions, identified the probability of an upside data surprise, and quietly built their downside exposure into silver futures before a single retail investor had any awareness of what was being constructed. First wave of selling hit. Silver began sliding from its daily high. Second wave followed immediately. The slide became a fall. Third wave arrived before midday. The fall became a controlled demolition. By the time silver reached $75.29, the institutions that had engineered this move were already unwinding their short positions, locking in returns, and rotating capital into the next trade. The retail investor was still watching the price fall, still reading about Iran, still waiting for an explanation that made sense. This is not a story about one bad trading day. This is a story about two completely different financial worlds operating simultaneously on the same market. One world prepares. One world reacts. One world writes the story in advance. One world reads it 3 hours too late. And today, the gap between those two worlds cost billions. But the deeper consequence of this morning's inflation number extends far beyond today's silver chart. It has reset the Federal Reserve's policy timeline through the end of 2027. It has closed a window that silver needed to reclaim its highs. And it has set in motion a chain of economic consequences that will reach into real estate, equities, and the savings of every working person who believed the worst was already behind them. That chain reaction, and what it means for every serious investor watching right now, is exactly what Part 3 breaks down, what the silver crash is really telling us. Most people watched silver fall today and saw a loss. A number dropping on a screen, a portfolio turning red. A bad day in the metals market that would eventually correct itself and return to normal. But there is a category of investor who watched silver fall today and saw something entirely different. They did not see a loss. They saw a message. And that message, written in the language of price action and institutional positioning, is one of the most important economic warnings that global markets have delivered in the past 3 years. Silver has never been a simple commodity. Throughout history, across every major economic cycle, silver has functioned as something far more sophisticated than a metal that sits in a vault or gets soldered into circuit boards. Silver is a diagnostic tool. It measures the health of the global monetary system with a precision that no government report, no central bank statement, and no Wall Street forecast can match. When silver rises, it is telling the world that confidence in paper money is weakening. That inflation is structural. That the system is under stress in ways that official data has not yet caught up with. When silver falls violently, as it did today, it is delivering a different, but equally important message. It is telling the world that the cost of money is about to stay high for much longer than anyone is comfortable admitting. And today, silver delivered that message with complete clarity. To understand the full weight of what happened today, one must step back from the silver chart entirely and look at the broader economic landscape that surrounds it. The Federal Reserve has been fighting inflation since 2022. It raised interest rates at the most aggressive pace seen in 4 decades. It tightened financial conditions across the entire economy. It accepted the pain of slowing growth in exchange for the promise of bringing inflation back under control. And for a period of time it appeared to be working. Inflation numbers were cooling. Markets were celebrating. Economists were writing articles about the rare achievement of a soft landing, a scenario where inflation is defeated without triggering a full recession. That narrative was always fragile. Today it broke. What this morning's inflation data revealed is not just a 1-month anomaly. It revealed a pattern that serious economists had been quietly tracking for the past several months, but were reluctant to state publicly because the implications are deeply uncomfortable. Inflation in the United States is not defeated. It is shifted. The first wave of post-pandemic inflation, the kind driven by supply chain disruptions and consumer goods shortages, has largely resolved. That is the inflation the Federal Reserve was successfully fighting, and that is the inflation the headlines were celebrating as a victory. But beneath that surface victory, a second wave of inflation has been building quietly in the services sector. In housing costs, in insurance premiums, in the wages that businesses must pay to retain workers in a labor market that refuses to loosen the way traditional economic models predicted it would. This second wave is structurally different from the first. It is slower to respond to interest rate increases. It is more deeply embedded in the daily cost of living. And it is far more difficult to defeat without causing the kind of economic pain that no central bank wants to publicly acknowledge it is willing to inflict. This is the reality that silver priced in today. Not Iran, not oil, not geopolitics. Silver priced in the recognition that the Federal Reserve is trapped. On one side, inflation that refuses to return to the 2% target without significantly higher rates or a prolonged period of restrictive monetary policy. On the other side, an economy carrying a debt load at the federal, corporate, and household level that cannot sustain significantly higher rates without triggering a wave of defaults and contractions that would make today's silver drop look trivial by comparison. There is no clean exit from this position. And silver, the most honest asset in the room, reflected that truth today before any economist, any central banker, or any financial anchor was willing to say it out loud. History has seen this before. In 1980, silver collapsed violently as the Federal Reserve under Paul Volcker made clear that it would keep rates elevated regardless of the economic pain involved. What followed was a brutal recession, a wave of corporate bankruptcies, and a complete restructuring of the American economy that took nearly a decade to fully process. In 2008, silver dropped sharply in the early stages of the financial crisis as liquidity evaporated and institutional investors were forced to sell their most liquid assets first to cover losses elsewhere. Those who understood what silver's movement was signaling had a narrow window to reposition before the broader collapse arrived. In both cases, the investors who paid attention to what silver was communicating, rather than what the headlines were explaining, had a measurable advantage over everyone else. Today is not 1980. Today is not 2008. But the language silver is speaking right now carries the same weight, the same urgency, the same warning. And that warning points directly toward a specific set of consequences that are now being set in motion across real estate markets, equity valuations, small business lending, and the retirement savings of millions of people who have no idea that what happened in the silver market today has anything to do with them. It has everything to do with them. And Part 4 explains exactly what happens next. What happens next, and how to position. There's a moment in every major economic shift where the window to act is still open, where the data has spoken, the institutions have repositioned, and the consequences are already in motion. But the ordinary investor still has enough time to understand what is happening and make intelligent decisions before the full weight of the shift arrives. That window exists right now, but it will not stay open indefinitely. What happened today in the silver market was not a conclusion. It was an opening chapter. The $5 collapse, the billions wiped from precious metals positions, the institutional repositioning that executed with surgical precision before most investors had finished their morning coffee, all of that was simply the market absorbing the first shock of a new reality. The real consequences of this morning's inflation data have not yet fully arrived. They are moving through the financial system right now, slowly but with complete certainty, the way a fault line shifts quietly beneath the surface before the ground above it finally breaks. And to understand where those consequences are heading, one must look at three distinct scenarios that now define silver's future through the end of 2027. Scenario 1. Prolonged suppression. This is the scenario that institutional traders are currently assigning the highest probability. The Federal Reserve, faced with inflation that refuses to return to its 2% target, keeps interest rates elevated well into 2026. Financial conditions remain tight. The opportunity cost of holding silver stays high. And silver, unable to find the monetary tailwind it needs to sustain a meaningful recovery, trades in a compressed range, frustrating both bulls and bears while capital slowly rotates into short-duration treasury instruments and dividend-paying equities. For the ordinary investor, this scenario is not dramatic. It is something far more damaging than drama. It is a slow, grinding erosion of purchasing power disguised as stability. Portfolios that appear unchanged on the surface are quietly losing real value as inflation runs above the return on most conventional assets. This is the scenario that punishes patience most severely. Scenario 2, controlled decline. If the inflation data released this morning represents the beginning of a sustained reacceleration rather than a temporary spike, the Federal Reserve may find itself in a position where it must consider raising rates further rather than simply holding them at current levels. In that environment, silver does not stabilize. It continues to fall. Key support levels that technical analysts are currently watching sit at $72.50 and $68. A breach of 72.50 would signal that institutional conviction on the downside has strengthened. A breach of $68 would represent a structural breakdown that historically takes 12 to 18 months to recover from. For businesses that hold commodity exposure, for investors with significant precious metals allocations, and for anyone whose financial plan was built on the assumption that silver would continue its upward trajectory through 2025, this scenario demands an immediate reassessment of risk. Scenario 3, the reversal. This is the scenario that precious metals bulls are holding on to, and it is not without foundation. If inflation, despite today's surprise reading, begins to show genuine signs of cooling over the next 2 to 3 months, and if the labor market softens in a way that gives the Federal Reserve the confidence to begin signaling rate cuts, silver could recover sharply and quickly. Precious metals markets are capable of violent reversals. The same institutional machinery that drove silver down today can drive it back up with equal force when the monetary environment shifts in its favor. But here is the critical distinction that separates informed positioning from wishful thinking. A recovery in this scenario is not guaranteed by hope or historical averages. It is conditional on specific measurable data points that have not yet materialized. The investor who positions for this reversal must be willing to define exactly what evidence would confirm it, and exactly what evidence would signal that it is not coming. Conviction without conditions is not a strategy. It is a gamble dressed in the language of analysis. Beyond silver itself, the road ahead carries implications that extend into every corner of the economy that serious investors and business-minded entrepreneurs need to understand clearly. Real estate markets that were quietly beginning to thaw under the assumption of coming rate cuts will now face a prolonged freeze. Mortgage rates that were expected to ease will remain elevated. Transaction volumes will stay suppressed. And the commercial real estate sector, already under significant stress from office vacancy rates and refinancing pressures, faces a more hostile financing environment than it had prepared for. Small and medium-sized businesses that were planning expansion based on the expectation of cheaper capital will need to revise those plans. The cost of borrowing remains high. The margin for error in business decisions becomes narrower. And the entrepreneurs who thrive in this environment will be the ones who build for capital efficiency rather than capital abundance. Equity markets, which have been partially sustained by the belief that rate cuts were coming, will need to reprice that assumption. Not every sector will suffer equally. Companies with strong cash flows, low debt, and pricing power will demonstrate resilience. Companies that were surviving on cheap capital and future promises will face a much harder reckoning. So what does the serious investor, the business-minded individual watching this analysis right now, actually do with this information? The answer is not to panic. The answer is not to liquidate everything and wait for clarity that may take years to fully arrive. The answer is to think in terms of what this environment rewards and what it punishes. It rewards cash flow over speculation. It rewards financial discipline over aggressive expansion. It rewards the investor who understands that in a world of expensive money, the quality of every decision matters more than the quantity of positions held. It punishes leverage. It punishes assumptions built on a rate environment that no longer exists. It punishes the investor who mistakes a quiet market for a safe one. Silver told the truth today. The headlines obscured it. The noise of geopolitics buried it. And the majority of investors walked away from this trading session with the wrong explanation for what they witnessed. But the truth was there, written clearly in every tick of the price action, in every institutional sell order that executed before the retail world woke up, and in every data point inside that quiet government report that nobody talked about on primetime television. The smart money read that truth this morning. The question that now matters, the only question that separates the investor who navigates what comes next from the one who gets caught in it, is simple. Are you reading it now? This has been Financial Crisis Explained. If this analysis gave you clarity in a world full of noise, share it with someone who needs to hear it. The market does not wait, and neither should you.